The mutual fund industry has grown by leaps and bounds over the last couple of years. It's been a phenomenal time. Assets of the industry have now crossed 50 lakh crores. Many funds have done phenomenally well. Stars have emerged, others have actually gone down. But there's a singular phenomenon in the industry, and that is one mutual fund from being a very small-sized fund 3 years ago is now one of the giants of the industry. I'm talking about Quant Mutual Fund. With assets of about 500 crores in December of 2020, the size is now 100x. Actually, more than that, 53,000 crores to be precise. And we are sort of coming to you from the floor of Quant Mutual Fund's office here in the heart of Mumbai. And with me is the man who's made all of it happen. Sandeep Tandon is founder and chief investment officer at Quant Mutual Fund. Sandeep, great to have you with us here.
Thanks.
Thank you very much.
Thanks.
I mean, I think our viewers and everybody just wants to know, simply put, how do you do it? It's a simple question, but not a simple answer.
Okay. So let me start with saying that, see, over a period of time, we have groomed certain things. We have started looking at a one-dimensional approach. Somebody says, I'm a valuation analytic. Somebody says, I'm a chartist. Somebody says, I'm a macro guy. Somebody says, I do something like this. Okay. But then we realize in last 30 years of my experience in the market thing that this is not effective way. We have to look at multidimensional, okay? Because one data points can be skewed. See, ultimately, in everything in life is relative. So absolute numbers are important, but relative numbers are more important. So when we talk about, give you a small example. In today's world, everybody talks about valuations are rich. And what example we'll give, we'll talk about 2000, we talk about 2007, 8, we talk about 17, 18. Yes, I agree, is rich. But if you look at in one dimensional, that is purely looking from the valuation point of view. But what happened to the liquidity aspect? Okay, when COVID happened, market rallied, let's say from March 2020, by September, everybody says this is a liquidity-driven rally, tsunami of liquidity. So liquidity analytics also plays a very important role. So if I look at what was the situation, let's say in 2000 liquidity, the global liquidity versus today, today global liquidity is more than 170, nearly $180 trillion, which is 2 times of the global GDP. Okay, it is few hundred times of that number what was in 2000, and it is few times as compared to 2007-8.
So you're saying that liquidity supports a much higher valuation.
Also, okay, and then you look at the sentiments. Okay, and the sentiments is very different. 20 years or 30 years back, India was very different. Look at from a perception point of view. Today is India's moment. We have arrived. I always say in my 30 years of my career, I have not seen such phenomenal macro. Both if I look at from absolute perspective and relative perspective. In fact, absolute is good, but relatively it's extraordinary. When whole world is going through a difficult phase from a geopolitical, look at the political stability in this country.
How do you quantify? Do you quantify sentiment?
Yeah, we do quantify. Okay. So it's
I'll come to sentiment. Yeah. So there is valuation.
Yes.
There is liquidity.
Yes.
There is sentiment.
Yes.
What else?
Okay. This is a 3 important parameters which we look at. This is what we call valuation analytics, liquidity analytics, and risk appetite. We give 1/3 weightage to each.
Okay.
And then is the most important element is the time analytics. Okay. So time is a function of, when I say time analytics is a function of these 3 analytics.
Okay.
So which in turn I can drill down further.
So just one thing, when we say sentiment, right?
Yeah.
And you quantify sentiment.
Yes.
So when we look at charts, for example, don't charts give us that? I mean, people look at charts exactly for that, right? Where is the supply? Where is the demand? Where are the extremes?
So if I look at the technical aspect, is one small form of it. There you can say at this price point, extraordinary volumes are there. So the next time you look at the psychological barrier, if these barriers happen, and it is accompanied by much higher volumes. So obviously, in the previous supply which happened, will got absorbed, and now it's moving to the next level. So up to certain extent you can call it, but we don't depend on the technical analysis in that sense. Mathematically, if I look at any data point, whether it's a Fibonacci series or exponential series or any data point, ultimately, as a mathematical firm, we do look at cycle analytics in a big way. Cycle analytics is part of, along with our money flow analytics, when we look at, we do look at these data points, but we define in a different way. Not just, technical analysis could be just a very myopic view. But yes, sometimes it gives you a perspective. Answer is yes, we do, can we ignore it? No, we do capture that, but we capture through mathematical route rather than capturing through graphical.
And what you called valuation, that captures fundamentals.
Yes.
Right.
1/3 is hard code valuation, okay, cash flow analytics, which we do. But our advantage is that when we look at data point, we don't look at the forward. Okay, the entire industry looking at 3 years forward. We work only on the trailing because instead of looking at the P multiple, is something we have built called perception analytics. The advantage of perception analytics, it is backed only on the previous data. When you bring anything which is forward looking, obviously there are challenges because forward looking statements are always coming from certain assumptions. So 4 analysts or 4 different money managers' house will have a different perspective. The moment assumption changes, then you have positive or negative surprises. So we don't believe that. Do you say that we ignore that? No, we don't ignore that. But we use these data points, let's say a forward-looking earning or consensus call, as an additional catalyst. It can act as a trigger. A lot of people market look as a trigger. So this can be a catalyst, but not form the part of the base models.
Okay. You also look at a fair bit of macro, global macro.
Yes.
And that's it's not surprising, but the bulk of the mutual fund managers or industry that we speak to, they say, well, macro shacro, let's keep that aside. It doesn't matter. What matters is what the business is worth, and you're able to calculate it and give some value to it. But your approach is different in that sense. Macro is an very important variable for you.
See, when we talk about, I agree industry, we have worked in the previous avatar as a broker, people largely look at the bottoms up, okay? But we are a top-down house. The advantage of a macro data is that we get a much larger perspective. The canvas is far bigger. So from very large macro, we come to micro. So if you give example, okay, if you talk about, let's say example, the largest company, let's say Reliance Industries, okay? If you don't have a perspective on where crude prices are heading, okay? If you don't have a perspective of the currency price, I'm just giving for example's sake, okay? Then it's very difficult to visualize the earnings. Look at the IT companies when the hedging was not proper. People used to consider 5% depreciation over a period of time, okay? Which has become now, you continuously take certain depreciation, oil prices will continue rise, rupee will continuously fall. This assumption has worked in the past when we were emerging market economy. Now we have much better economy, or rather more mature economy. That perspective has changed. It doesn't work. So if your certain assumption which you have built the entire thesis is wrong, and if you can't predict those things, and you're assuming this will happen, so by default your earning assumption or revenue calculation, everything is wrong.
Sandeep, whenever I've met you and I've spoken with you, you've always emphasized the importance of behavioral sciences, and that's an important input for you in that sentiment indicator that you look at. Can you use an example to explain how you put it into use?
See, frankly speaking, Prashant, when we talk about markets, we always talk about fear and greed aspect. Okay, people can feel whether the greed has intensified or we are seeing a capitulative phase. Can you quantify? Okay, now through the help of macro data, we can actually quantify with the help of predictive analytics. We can quantify the macro thesis. And let's say talk about gold or crude. In multiple occasions we have done it. Yes, we can quantify the intensity of greed, intensity of fear. Let's talk about, let's say you as an individual have certain characteristics of your fear, greed, anxiety, frustration. I may not be able to quantify an individual, but our asset classes as well as particular sector and stocks we can quantify, because we look at the cumulative effort of the society where the masses role also play. The behavior of a FI or institution is slightly different from the behavior of retail characteristic. So we try to decode these mysteries and create some numbers around that. And it is a continuous process. So we can see whenever we see a capitulative move happening in a particular sector or some sort of euphoria getting built, like a lot of people say there is a euphoria. I keep on highlighting that we have not seen a classic euphoria which is required for market to peak out. Okay. That feeling has not come in. Now you can feel it, but I can quantify it. So it can be quantified with the help of macro data as well as the micro data.
So I think one area where there is, maybe euphoria is the wrong word to use for it, is the huge participation of retail. And who better than you to actually talk about what we are seeing out there in the markets, right? I think, what is it last AUM? 53,000 crores?
Yeah.
And how many folios?
54 lakhs folio we have.
54 lakh folios, which means that many investors. I mean, with some duplication, but more or less.
More or less.
I mean, that's a very large number.
Yeah.
What do you make of it? I mean, and you've been, by the way, this is the latest avatar, Quant Mutual Fund, and what you're doing. You've been in the markets for 30 years. Okay. Have you seen anything like this?
No, this sort of phenomena we have not seen. But I tell you, let me give you a perspective like how you have evolved in the last 15, 20 years of your career, maybe in the last 30 years I have known. We have evolved with mistakes. Okay, if you will say, people say, okay, you manage money and your success rate is high, but I can tell you all this VLRT framework, everything get built with some mistakes. Not mistake, I use the word
What
blunders.
works, what does not work?
So we have built these theses around mistakes. Now same thesis I'm extending for retail. So when you look at retail in 2000 or 2008, in that period when they were relatively young, okay, and they typically come at the peak of the cycle.
Correct.
Okay, retail has come at the peak of the cycle. In Hindi we say गाँव को थोड़ा रिस्पेक्ट देने का है. गाँव comes or retail comes at the peak of the cycle is a contrary indicator. When retail participation is high, market peaks out.
Correct.
Now that phenomena has changed. In last 10 years particularly, I have seen that the behavior characteristics change, and it has changed a lot post, if I have to talk about post-COVID. Okay, when they were on vacation period sort of thing, they analyzed their portfolio, they were early participant. And now they are actually a beneficiary of whatever phenomena of GDP or the macro picture which is changing, and they have understood they are there from longer term perspective. They have understood.
And from a
buy
fund
on dips.
perspective, you are actually seeing that.
Yes, we see
some of the highest inflows that you're getting is on down days.
Yes, down days.
Right.
So market has become so mature, a participant becomes so mature in down days, retailer is able to participate much more.
Correct.
Okay, and in the normal days we see less flows.
Right.
So it's very interesting thing. Typically, otherwise used to happen at the bottom of the cycle. People capitulate and they will withdraw money and go. Now reverse is starting. That's the reason I say this rally, which is happening right now, is led by retail and has more legs because the size of retail which has.